Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/Rive to receive the top 10 stocks to buy right now. Investors are paying a lot more attention to dividends in 2023, but that doesn't mean that every dividend stock and every high yield stock is a kind of stock that we should be buying. So I wanted to highlight a few stocks where I think the dividend is actually a red flag for the company and the stock, and explain why high yield dividend stocks are sometimes not great investments. My name is Travis Hoium. Thank you for watching Rive Investing. Please subscribe here on YouTube for all my coverage. And don't forget to visit fool.com/Rive for the Motley Fool's top 10 stock picks to buy right now. I want to start with looking at the energy sector. Now, energy stocks have done extremely well, especially in oil and gas over the last couple of years, because high energy prices and an increased usage as we've come out of the pandemic have been a boon to their operations. Russia's invasion of Ukraine kept some of the supply of particularly natural gas off the market in Europe. That increased prices. And then there's just overall been more economic activity. So there's more demand for oil. And this comes at a time where oil companies are actually cutting back on their spending. So as a result, these companies have had a ton of cash flow. Earnings have been up, dividends have been up, buybacks have increased, and these stocks have just done really well. But there's starting to be some red flags for these companies, and two stocks in particular that I want to bring up are Petrobras, the Brazilian oil and gas company, and Devon Energy, which was one of the top performing stocks in 2022. So let's look at a couple of charts here. The first one is from Petrobras, and you can see that the company has been paying a ton of money back to investors. This is in part because the company is controlled by the Brazilian government, and they have really prioritized putting that money back into the Brazilian economy rather than investing it in the company itself. But that dividend that's being paid out right now is probably not sustainable. This is something that the company has actually been fighting back on, trying to reduce their dividend. So there are signs that's going to happen. But if you were just looking at stocks and looking for high yield stocks, this is one that would absolutely pop up because the dividend yield right now is well into double digits. But you can see here that it's probably not sustainable where it is at the current point, given the cash flow from operations, free cash flow, and the payout that's going out in the form of a dividend. I'm going to get into the reasons for the question in these cash flows long-term in just a second, but I want to bring Devon Energy into the discussion here because this is a much higher quality company, but still $8.5 billion in cash from operations, free cash flow over the last year, $3.4 billion, and that dividend payout, the amount that's actually going out to investors, $3.4 billion. So there's really not a lot left there for the company to grow operations or invest in new projects. Like I said, this is coming at a time that companies were actually pulling back on the amount of oil and gas that they're drilling for. So the growth potential is not what it was. What we really needed to see to keep these earnings and cash flows really high is high oil prices. And that's what's really changed over the last year. You can see here that oil prices have dropped significantly since peaking early in 2022. This is the 1-year chart, and both West Texas Intermediate crude and Brent crude are down over 25% in that period of time. There are a number of reasons for that. One is that there is some drilling that's starting to come back online. So supply isn't quite the issue that it was a year ago. There's worry that the economy is going to start slowing down. So maybe demand isn't growing quite as quickly as people expected. And China's economy isn't the draw from a demand perspective that a lot of investors thought it would be late in 2022 and early in 2023. So when oil prices come down and natural gas prices come down, they've had a similar trend. That means there's not as much cash flow for these oil companies. These are both dividend yields in the double digits, but they're dividends that I would question going forward. So they're not stocks that I would be buying right now based on that dividend yield. Another big dividend yield I want to cover is Annaly Capital Management. This is a finance company that owns primarily mortgage-backed securities and borrows money short-term, lends it out long-term, tries to make money on that spread. But that business has really gone the opposite direction over the last year as interest rates have increased. That's increased the cost to borrow money and reduced the amount of money and reduced the value of the assets on the balance sheet that have a longer duration or a long period of time until assets mature. There are a number of challenges for Annaly, and the dividend is already starting to come down, but still, based on last quarter's payout, yields 13.7%. But the pressure is likely to grow on this business. As interest rates go up, people are going to stay in their homes longer. That means that the assets that are currently on the balance sheet are going to be there for a while, despite the fact that they're at depressed prices because interest rates have gone up. The result from an income perspective is earnings per share last year in the fourth quarter was $1.07. And in this most recent quarter in 2022 was a loss of $1.96. So definitely heading in the wrong direction there. This is a company that I would expect to continue cutting its dividend and wouldn't be surprised that sometime over the next year they eliminate that dividend altogether to try to just shore up capital. But that's a balancing act the management is going to have to play there. And the trouble that we've had in the banking sector just shows how quickly some of these businesses can really unravel because of higher interest rates. And the final dividend stock that is a red flag for me is Vornado Realty Trust. This is a REIT that has a dividend yield of 10.7% right now. They own primarily assets in New York City and are focused on retail and office space. And these are both segments that I think are coming under pressure right now because of those higher interest rates. The economy is starting to slow down. Companies are not getting office space as much as they were a few years ago, particularly as more people work from home. And I think areas like New York are going to suffer the most because there's going to be less demand for the limited amount of space that's there. That's going to put pressure on Vornado's results. Now, this is not going to be a company that's going to collapse like a bank does, but over time, those rents can deteriorate, occupancy can deteriorate, and we clearly know that borrowing costs are going up. So there's going to be pressure from both the revenue side and the cost side of the equation for Vornado. They do need to pay out their cash flows. So as long as cash is coming in, they're going to need to pay that out to investors. That's why that dividend is over 10%. But that high yield indicates that investors don't think that payout is going to be that high for all that long. And so I would expect that to come down potentially over the next few years. This may be something that plays out over time, but definitely not a dividend stock that I would buy and expect to keep that dividend where it is right now. That's likely to fall in the future. So the 4 stocks we covered today that I really question their dividend is Petrobras, Devon Energy, Annaly Capital Management, and Vornado. I'd love to hear your thoughts on those 4 companies and their dividends going forward. Thank you for watching. And don't forget to subscribe to Rive Investing here on YouTube. And I'll see you here again next time.